Now it's one thing and one thing only: pain avoidance. The deepest pain, a debt deflation. Europe potentially staring down the barrel of that gun right now. So what do? Well, what if they were to actually raise interest rates? Oh my God, you get, say, a 200 basis point deposit rate. Now all of a sudden, fixed income is fixed income again. You're paying investors, you're paying depositors to put money in the bank. And on the flip side, the ECB, using the LTRO program, is able to establish a borrowing rate for banks that say minus 100 or minus 200. Say you had a symmetrical minus 200 plus 200 two-tiered system, a deposit rate against a borrowing rate for banks. Now the thought process goes so far as to suggest what would happen is that this would facilitate banks making loans to consumers and businesses at minus 50 basis points. Essentially, paying consumers, paying businesses to borrow more money. I mean, negative interest rates, the thought process was that's going to be a penalty dynamic that will force consumers to go out and spend money. It's not how it's happened. It's sucked money out of the system. So in this case, this kind of setup, while dramatic, while QE on steroids, would have some desired impact if your desired impact is to kind of push for a reflation. But at the same time, on the back end of that, you might get some severe reversals in some of the markets, like the deposit rate futures, which are pricing in rate cuts. If you hike rates, you're going to have a massive opportunity to be short those contracts. Something like the bonds would probably get hit too. Yields would start to rise. The flip side would be stock markets would probably love this idea. At least for some time period, it would be a honeymoon for the stock markets. And really, when you come back down to it, this might be the most bullish thing I've heard, potentially, if it were to ever come to fruition, the most bullish thing for gold that I've heard in 35 years of doing this. Against that backdrop, the view on gold is very positive, and it's even positive to the degree that the last 6 to 9 months haven't been negative. Because if you look at the dollar, and the dollar's trading, 98.5, the dollar is bidding to kind of break out here in a short-term basis and get back to the highs from 2016, closer to 104 on the dollar index. The trade-weighted dollar index is been even stronger. And against that backdrop, gold has not cracked. If you overlay these things, gold would be trading more along the lines of 1,100, maybe as low as 1,050, given where the dollar is. That delinkage is huge, because what it tells you is if the dollar is the strongest currency out there and gold is appreciating in dollar terms, that means gold is appreciating against all paper currencies. That's the sweet spot for gold. That's what you have right now. In fact, the gold adjusted value of the dollar index, simply the dollar divided by gold, really not rocket science, is on the verge of a major breakdown into what has already been a secular breakdown. So it would be a fresh leg down here, which would mean, obviously gold's already broken out above this 1375 level. That was key resistance. And if you lay out the technical structure on a long-term basis, even going back to 1971, when Nixon delinked gold, from the dollar officially. This has kind of been a 4-wave setup. All right, wave 1, 2, wave 3 was into the 2011 high. The most recent correction to the lows around 1050, lo and behold, it's almost a perfect 50% retracement of the entire bull move from 1971 to the 2011 high. And I remember specifically, just watching this very closely back when gold was under pressure into, late 2014 and into the 2015 low. The number of days that you got below that 50% retracement and then closed back above it, the number of kind of tailed reversals like on a candlestick chart that you might see below this 50% retracement level just belied so much demand there. It was uncanny to watch the math and to watch how it played out, in the manifestations of the market movements to where it held that level. More recently, there was some questions around gold. Was maybe going to break 1260 again and could have had another significant $100, $150, $200 decline, and it didn't do that. So when you throw all this into the mix, let alone you take places like Angola, Pakistan, Colombia, Uruguay, Uzbekistan, Kazakhstan. I mean, gold in these currencies, record highs in almost every case. So a lengthening list of currencies against which gold is at record highs, including the Aussie dollar, for example, including, some major currencies, Swedish krona, would be another example. And then you look at the dynamic around how the dollar is playing out in this context. Again, you kind of go back to, if the ECB is going to pull some, QE on steroids rabbit out of a hat here, okay, wouldn't it make sense that gold is kind of appreciating in all paper currencies? Because essentially what you really have going on here, at the end of the day, the most base case at the instinctive level is a growing uncertainty, fear, and even mistrust around all paper. They're just going to keep printing more and more paper every time there's an issue around disinflation, deflation. Well, at some point there is a level of uncertainty and anxiety around all that paper. And it is IOUs. Currencies, sovereign debt, it's all the same. It's an IOU. And, it's kind of cliche, but it is powerful and it's true. The dynamic around gold being kind of an offset to all of this paper that they just keep printing.